Did you know you can design a life insurance policy for more than just protecting your life? You can actually use it to grow your wealth. And that's what we're going to talk about here today, is designing a policy to maximize your cash value. If you're new to this channel, my name's Gartner with Epic Financial Strategies, and we're going to get into maximizing the cash value of life insurance and how we design that type of policy. So step one, what we're going to talk about is the health qualifications for insurance. So the first step is receiving a physical health evaluation. Health is a critical factor since it's still a life insurance product, and staying healthy is essential even if the goal is becoming your own bank. But let's get into this, right? So what you really need to do here is get approved by a life insurance company. And any of the good quality life insurance companies are going to require that you have a medical done. So the people that you work with will schedule that medical exam for you. That information will go to the life insurance company. There will also be a lot of health questions that are answered. And the important thing is to be fully transparent when you go through that underwriting process. The person you're working with should do the best they can to paint you in a positive light to that life insurance company. But let me just clarify one last piece on there. Is staying healthy is important for you, but it's not important once that policy is in place, because once your policy is in place and that rate is locked in, it is set and your rate cannot change, right? So the life insurance company can't all of a sudden come back and say they're going to charge you for more if you're using the right type of whole life insurance. And the second step is the financial underwriting. Financial underwriting assesses the income to determine insurance limits. It matters how much you make. Unrealistic financial declarations, such as, you have a $30,000 salary, but you're looking to put $30 million into a policy, or you want a $30 million death benefit, it's unrealistic. And that's not permissible. It's not smart for you as a person to put all of your money into life insurance. And to that point, insurance stability is gauged based on your income. It's not suitable by the insurance company for you to put in 50% of your income, right? Like if you wanted to put $50,000 into a policy every year, but you only earn $100,000. So these are the things that the insurance company is going to look at, and they're going to justify or make sure that this policy that's being recommended is suitable for you. So it's important, again, to make sure you're going through and looking at what your actual income is, not after tax, but your gross income and maybe the household income. There can also be other factors. You may be retired and looking to put one of these policies together, and in that case, we may not look at, or the insurance company may not look at income, but they'll actually look at the assets that you have. Step number 3 should be a full cash flow analysis. Infinite banking is a long-term financial strategy. Determining a non-negotiable monthly investment amount is crucial. There are limits to how much can be contributed, with both a floor and a ceiling on the payments to ensure compliance. And what we're talking about here is something that you'll hear about a lot on the internet, is how much is going to quote unquote the premium or the insurance policy and how much is going to the cash value. And that is not so cut and dry. You'll hear a lot of people talking about a 90-10 split or a 50-50 split, 60-40, 70-30, all these different kinds of splits and premiums. What's important for you to understand is you have to have a certain amount of baseline premium to support the amount of overfunding you want to do. This is why it goes back to needing that health qualification, because all of this is used to build out the policy properly for you, adding the right amount of permanent death benefit with the right amount of term life insurance, understanding your cash flow and understanding what a comfortable amount is to put towards the policy each and every month or each and every year without fail is vitally important. You want to know that number first, and then how much do you expect to be able to overfund each and every year. And those are some of the steps that we'll do in our cash flow analysis, is to help you figure that out. To go a step further, what we look at is, are there dollars that you're spending in places that can be reallocated, right? Are you prepaying a mortgage when you have a very low mortgage interest rate? Are you spreading debt, right, and paying small amounts to debts rather than tackling the smallest debt first and doing that snowball methodology? These are things that we'll discuss inside of our cash cash flow analysis with you. And just as I was talking about before, it really comes down to structuring the policy the right way, right? And what we're looking at here is a policy structure and tax compliance. The goal is to have the minimum permanent death benefit necessary, supplemented with term insurance to avoid a modified endowment contract and the accompanying tax implications. So let me break it down for you. A modified endowment contract is what the government has created when you overfund a life insurance policy and you put too much into it. Relative to the death benefit that you have, the government says, hey, you know what? You're going past what our thresholds are. You're putting too much into this, and we're going to take away the good tax benefits of life insurance. So what that means is if you're under 59 and a half, any distributions from the policy, whether they be a loan or not, are going to have a 10% penalty, and any gains inside the contract are going to be taxed at ordinary income. So when you design the policy properly, you avoid that modified endowment contract and you maintain all the good tax advantages that life insurance has. Structuring the policy requires a balance. It's an art rather than a strict formula to ensure that it sustains both short-term and long-term. Again, this goes back to that 90-10 split or 10-90 split, whatever people are talking about on the internet. The stability of the policy is really what's most important, and doing too small of a baseline premium and too much into that paid up additions rider hurts the long-term stability of the policy. So these are things that you really need to be careful with when designing the policy. And lastly, the policy should be designed so that funding can eventually be discontinued without the policy collapsing, allowing the policy to continue to grow independently. This is something that you see with IULs, that people will show you stopping making premium payments, but if you pay close attention to those illustrations, there can be a real detriment to the policy. A policy can collapse if the markets don't perform exactly how you need them to perform. With a whole life insurance policy, the cash values aren't correlated, and if you use a reduced paid up option, meaning the insurance policy is completely paid up, it will guarantee a death benefit, it will protect that cash value, and if dividends continue to be paid, that policy, those cash values will continue to increase, as well as the death benefit continuing to increase. If you found value in this video, go ahead and give it a like and share it with some of your friends that are looking at this same information, trying to determine how to build out a policy. And if you're looking to speak with somebody here at Epic to go through that cash flow analysis, click in the description box below, fill out your information. One of the team members will reach out to you and set up a time to take you through that success process. And lastly, we're putting out videos like this all the time. Go ahead and subscribe to make sure you get more of this information, and check out this next video.